Building a balanced investment portfolio, including strategy, risk, and the efficient market hypothesis, by Finlay, Cawthorn, Emilio and Luke Clark. Client scenario and presentation objectives. So the client brief which we've been given, the client has inherited 100,000 and he seeks a balanced investment portfolio. His priorities are liquidity and growth and risk and return. So for the presentation objectives, we're going to give a recommended evidence-balanced portfolio. We'll analyse the risk and return of the characteristics of each asset. We'll outline tax implications and we'll discuss the implications of the efficient markets hypothesis. So here we've got the recommended investment portfolio. So as you can see in the pie chart, we've split our funds around equally, well, I say equally, in different ways. So we've got cash, so 10% of the portfolio is allocated to the cash. The purpose of this is for high liquidity and emergency access. 25%, which is 25,000, going towards bonds, which are government and corporate mixed. And this is stable returns and income. Then we've got 30%, which is the largest amount, going into UK equities, which are index funds. And this is growth with domestic exposure. That's the purpose for that one. And then we've got 25% going into global equities, ETFs, which is international diversification. So it's just diversifying the money all around. And then we've got alternatives, which can be like gold and REITFs, which hedge against inflation and volatility.
So this is a risk and return analysis of UK equities. We've allocated 30% of the portfolio to UK equities. Historically, they offer an annual return of around 6 to 8%, but this comes with a high volatility of around 14%. This means that prices can swing dramatically. And the reason we're including equities is the strong potential for capital growth. And rather than trying to beat the market, the efficient markets hypothesis supports a passive investment approach like index funds, which are cost effective and already reflect all available information. And here we have a small chart describing the average annual return of equities in the past 4 years. So we have in 2021, the return was 8.6%, 2022, 6.2%, 2023, it was 3.8%, and 2024, it was 5.7%. And then on to the next slide, we'll be doing a risk and return analysis of bonds. So the composition was 25%, and the expected returns for government bonds was 2 to 3%, while corporate bonds, the return was estimated to be around 3 to 6%. And it comes in with a risk level which is low to moderate and a volatility of 4%. And additionally, bonds play a stabilising role in our portfolio. They provide a reliable income through interest payments known as coupons, and they reduce the overall volatility of the client's investments. This is especially important given our clients' desire for both growth and liquidity. Bonds help to smooth out returns when equities can fluctuate. And then here again, we have a small chart describing the 5-year average annual return of each bond. So we have an iShare bond, which is a mixed maturity, and it has a 5-year average annual return of minus 5.1%. And for the LGIM bond, which is a long-term gilt bond, has an average annual return of minus 10.41%. And then for the next slide, we'll be doing a risk and return analysis for real estate investments. So we allocated our client with 10% of his portfolio, and the expected return is 6 to 8%. It comes in with a risk level which is fairly moderate, and the volatility is also medium. Real estate investment trusts diversify the portfolio by adding exposure to the property market, and they provide income through dividends from rental properties. This makes them a good middle ground between high risk equities and low risk bonds. For the next slide, we'll be doing a risk and return analysis of cash. So finally, cash is a vital component of the portfolio for its liquidity and security. It doesn't offer high returns, but it is essential for covering emergencies or short-term expenses. Keeping some cash ensures our client can access funds quickly without having to sell long-term investments at the wrong time. And then finally, we'll be talking about the tax implications. So it is important to understand how each asset is taxed. UK equities, they are taxed under capital gains tax, with the first £3,000 being tax-free. So basic rate taxpayers will pay 10%, while higher earners will pay around 20%. And then for bonds, they are taxed as income. However, gilts are exempt from capital gains, but corporate bonds might be taxed if they are sold for a profit by our client. And then next, we have real estate investment trusts, which is taxed like regular property income, ranging from 20 to 45%, depending on your income bracket. And then being tax aware can also help maximise the client's portfolio's net return. There are a couple of ways to do this. One is by opening up an individual savings account, also known as an ISA, which helps save money with no taxes or interest rates or anything like that. And then the second way is by opening a self-invested personal pension, which is another way which you can avoid tax and legally.
Hi, so I'm Emilio, and I'm going to be talking about the efficient markets hypothesis, also known as EMH. So firstly, what is EMH? So the efficient markets hypothesis does state that it is incredibly difficult to frequently beat the market, since asset prices accurately represent all available information. So there are three common forms of EMH. So the first is the weak form. This means that past market data reflects directly on the price, and which basically means that technical analysis is ineffective. The second one is semi-strong form. So this basically means when public information reflects directly on the price, and which leads to fundamental analysis not being able to consistently perform. The last one is strong form. So all public information and private information reflect directly on the price, and therefore even insider information can't garner the upper hand. And lastly, a key insight into EMH is attempting to beat the market won't lead to much success in the future if markets